Welcome to Sierra Capital's Family Office Fundamentals, a podcast dedicated to helping families preserve their legacies and wealth for future generations. I'm your host, Zev Zaretsky, Investment Director at Sierra Capital, a 25-year-old multifamily office focused on guiding ultra-high net worth families globally. In each episode, we'll explore a wide range of topics, including investments, trust and estates, family governance, philanthropy, and much more. Our goal is to provide you with a solid foundation to safeguard your family's financial, intellectual, and human capital for generations to come. Join us on this journey and stay tuned as we hear insightful conversations with industry experts and thought leaders right here on Family Office Fundamentals. Let's embark on this journey together. Please find important disclosures at the end of this podcast. All right, well, thank you everyone for joining us today. So today we have Sam Katz. Sam is the founder and managing partner of TZP Group, a $2 billion New York-based private equity, lower middle market firm focused on buyouts, growth equity, and structured capital. So I met Sam a few years ago down in Miami, where I learned about his fund and his career, and very grateful that he's coming on the podcast today to share it with us all. So let's get to it. Well, thank you, Sam, for coming onto the podcast. Really excited for the conversation. And I was thinking we could start with your background and how your career brought you to focusing on buyouts in the lower middle market space.
Sure. First of all, Zev, thanks again for having me. It's good to see you. And kudos to you for organizing the series to really help people understand this really important world of SBICs. My career is really in two chapters. It's like anything, there's always the sort of unintended things that lead you down a path that you ultimately find very rewarding and exciting. So I think when I grew up, I always thought I was going to go to law school and be a lawyer. When I was in college, I needed to get a summer job and sent out a lot of resumes and got an opportunity to be a cold caller at Bear Stearns. And that led to me working at Bear Stearns, including for someone who did risk arbitrage throughout the rest of college, and exposed me to the sort of world of M&A and deals, and so made me then pursue a opportunity to be an investment banking analyst when I graduated, so I could follow up on that interest, and that's where I started in investment banking. I was then fortunate to move, I guess, laterally to Blackstone when it was early in Blackstone's life, and spent the next, I guess, at Blackstone about 5 years, and then another 13 years thereafter, working on building up one of the Blackstone investments in a few hotel franchise brands, such as Howard Johnson, Days Inn, and Ramada. That was a company that had $20 million of EBITDA when we started, when it went public eventually, and then grew through a lot of transactions and strategic acquisitions to a company that in 2006, when it was split up, it had $2.8 billion of EBITDA and an equity market cap of over 20 billion, and had built up such brands as Avis Budget, Wyndham Worldwide, Realogy, and then two businesses which I had the good fortune to lead as the CEO as we built them up through transactions. One called Travelport, a large global travel distribution business, and Affineon, which is a leading direct marketing services provider to financial institutions. And so that was really what I did for, again, that whole period of time, 16, 17 years, working on transactions, on strategy, integration, and then getting the experience as being an operator. By 2005, 2006, it was no longer cool to be a large publicly traded conglomerate, and we made the decision to split the businesses up and sell a few of them, take a few of them public through a spin-off transaction. And so it was an opportunity for me to kind of figure out, the next chapter. And I thought about what I enjoy doing in terms of the transaction side and the operating side, and thought about how to integrate that in the traditional private equity world. And with the man who co-founded our firm, Vlad Gutin, who was at the time at Goldman Sachs, but we had known each other for about 10 years then. We decided we wanted to go start a private equity firm, but really around where it was something we could really enjoy and have comparative advantage, which is a skill that really always learned at Blackstone and was very much emphasized for me at Blackstone throughout my career. And so each of us reflected on that. We didn't enjoy working with large public companies, even though that's what Cendant was, and that's what Goldman did a lot of. But rather, we had the most fun dealing with founder-owned businesses in the low and middle market, where there was a huge amount of transactions and companies that we thought would find value in having a different kind of partner, one who brought a more sophisticated approach based on what larger companies did with their investments and their businesses. And we also thought that having a business model where you're participating in a segment that 90% of the companies in North America have less than $250 million of revenue, but more than 80% of the private equity capital goes to billion-dollar plus funds. And those funds are just buying, companies from one another, from one private equity firm to another, that the transaction with founders, where founders were going to remain owners of the companies through some equity rollover, whether majority, whether minority, that was a much better alignment because the founders were both sellers of equity, but also essentially buyers because they were rolling over into your deal at the same basis that you were paying. So we loved that alignment, not just liked it. And we loved the fact that we would be working with companies that were more dynamic and growing. I was very happy not to be working at a public company, and that's really the beginning of the chapter of TZP 16 years ago. Really around the idea is how do we offer capital solutions to founder-owned businesses in segments that we really understand and have good domain expertise and operating experience. So if you look at our portfolio today, it very much is in similar businesses that we built at Cendant. So we're leveraging now over 3 decades of experience. And also we've continued to build on that very operationally driven approach so that we could actually offer a legit value proposition to founders that, it wasn't just about the fact that, we were smart financial people, but that it ends up that nearly all of our partners on the investment side have had some kind of operating experience. And we've built out a separate 7-person portfolio operations group that are organized around functional areas, people in the prime of their career, and that allow us to really make good on that value proposition and what we call being a partner of choice to those founder-owned management teams. And so that's really the mission that we've been on. We're very selective. We only make a few investments a year. We made 50 platform investments over the last 16 years. And as we've grown, we started out with doing buyouts. Just then we added growth equity capability, and in the sort of spectrum between buyouts and growth equity, we've done what we call structured equity, or some would call it mezzanine type investing. And so that's really that desire to continue to offer more and more capital solutions for the founders of these companies and the management teams is what really led us to want to raise an SBIC.
Kind of gets to my next question, a little bit more about TZP. So you you left Blackstone, you started your own firm. Clearly, it wasn't the size or the amount of manpower that it is now. So maybe just for, so people who are listening to this podcast, maybe just a little background about the firm, how, where it started, what is it today? Like, what's the manpower behind it? What's the foundation that you're making these investments off of?
Sure. So just again to clarify that it was at Blackstone that we started what became Cendant. And obviously Blackstone sold out very successfully as the company went public. I think they made more than 5 times their capital in that original investment. But at TZP, we started originally with 9 people. We had our first fund was $180 million. Today we have about 55 people and manage over $2 billion of AUM. We have raised 7 different vehicles to invest and raise that capital, manage that capital. It's organized around 3 groups and 3 different funds today. The Capital Partners, which was the original, and it does the larger buyouts, which means that sort of the equity check is sort of north of $50 million, companies with at least $10 million of EBITDA. We have a small cap partners group, which does transactions that are typically equity checks up to $30 or $40 million, where there's EBITDA of less than $10 million, but usually sort of high single-digit million EBITDA. And then we have our growth equity team, which focuses on non-controlled transactions that are companies that at least have $10 million of revenue. Usually they're sort of more on the $50-60 million revenue. They are almost always profitable or very close to profitability. But the commonality is that across those 3 different groups, and they're separate groups of investment teams, they are sharing the same investment themes that they're pursuing. They're able to move deal flow around. If someone sources a deal where it's not a buyout, it's a growth equity opportunity, then they can put it in the other group. And so that makes the efficiency of all the sourcing efforts that much more impactful. And then each of the 3 teams and the underlying portfolios is supported, as I described, by the centralized portfolio operations group and the central finance and administration function. So, hopefully what we've been able to do is just get resources that are better than the typical firms that we compete with, or in some cases, they don't have any of these capabilities around portfolio operations because of their size. And so we have made this relatively uncommon horizontal expansion into multiple lower middle market funds so that we can create scale in the market that we find very attractive. And we're trying to avoid what many or most private equity firms do, is as they, over time, they grow, they raise larger and larger funds. But when you do that, you leave behind the kind of deals and the kind of relationships that you historically had, and you're now in this world of buying firms from one private equity firm to another.
So I guess in regard to the operational team, because that's definitely a differentiator, right? Most lower middle market private equity firms that I've talked to, that I've seen, may have operating partners that aren't full-time for the firm. They only jump on specific deals. You actually have a dedicated team that's there, full-time.
Yep.
So maybe just 1 minute on that. What are the type of things that they're touching? Are they touching the general accounting function for a lot of your portfolio companies? Are they dealing with the banking relationships?
Yeah, so they are organized by functional capability. So we have a partner who focuses on operations, partner focuses on strategy, partner focuses on talent, partner focuses on data and analytics, a principal who focuses on digital, a support person who kind of focuses on infrastructure and so the reporting, and then another executive who's focusing on distribution issues. So, we have found that broadly, those are the things that really drive the initiatives that create value in the portfolio companies and the types of initiatives that we will pursue. The sort of bookkeeping, accounting stuff, there's support for that in that we arrange for ERP and financial system type of consulting and contracting relationships and support those implementations. But I think those are things that are more in the plumbing area that you can get at without all that sort of expertise. Yep. And these resources are oriented towards what we call net asset value growth.
Okay. So I know TZP is coming out with its first SBIC fund. Already has 7 non-SBIC committed funds, which you briefly discussed before. But maybe if you want to just give us a rundown of the prior funds, and what their focus really was, in terms of what's the sectors that TZP is focused on, and then on the SBIC side, for the firm, what does it mean for the firm, and why does having the SBIC give TZP a competitive advantage in the market?
Yeah, so I think, again, we're trying to create scale in the lower middle market, which is difficult. And as you say, we're unusual in that we have these full-time people that work for the management company, and people we compete with typically have more of these, variable relationships, not full-time, and they're sort of more on demand. The idea really behind the SBIC is an extension of how the firm started, which is how do we offer more capital solutions to the potential founder of business, depending on the transaction that they want to achieve. And we have found that a traditional buyout or traditional growth equity deal is not always the solution for these companies. And so we love the opportunity that we're going to have, hopefully, when we are licensed and in operation, to be able to offer, again, debt-like, structured equity-like capital solutions when that is the right outcome that the portfolio company needs, in addition to being able to give our SBIC investors exposure to the buyouts and the growth equities investing that we're doing. So it's really the SBIC will have the benefit of everything that we're doing across the capital solutions. When you tie it back to where we invest, we have what we call our 7 focus sectors. There's outsourced services, media and events, travel and hospitality, software and technology, consumer products, real estate services, and franchising. And that really, those are the segments, as I mentioned earlier, were very comparable to the kinds of investments that we invested in when we built Cendant. So we got 3+ decades of experience both investing and operating in these sectors. And that means that we've accumulated a lot of knowledge, a lot of relationships. We've gone through economic cycles. But really where it all comes together and having the multiple funds, including the SBIC, is the ability to get the scale benefit within the portfolio as well, and therefore be a better potential partner to the next founder-owned management company. So I'll give you, and I'll tie it back to our focus sectors. So one of the sectors within those categories, because it's not those are broad categories. So what we try to do is click in a more thematic manner. And so we've had a theme around active wellness. Right, the idea is that for a while people have been more focused on how to take care of themselves, and one way they do it is by enjoying activities that they like that are good for their health. And so, we've been investing around that theme, since, I guess, 2015, well before COVID made people more focused on all these kind of activities, right? And so over time, we have invested in a high-end performance apparel business for the cycling industry, a ski rental and equipment company, a outdoor skin protection business focused on apparel for fishing and hunting, a business that designs natural movement shoes that's focusing on people who are doing a lot of hiking and running and other outdoor physical activities. We invested in a youth soccer equipment and team related business. And number 6 was the leading dance competition business that's focused also on youth, sort of 5 to 18 years old, where that's their activity instead of soccer or climbing or whatever else it is. But guess what? Our 7th investment that we just completed in the active wellness theme was in fact a company called Headrush Technologies in our small cap fund that is the leader in auto belay systems for places that have climbing facilities. And so now we are in support of the climbing business. It's interesting because it goes back to one of our successful investments earlier in the firm, the small cap, was a business called Family Entertainment Group that ran these family entertainment centers, including managing climbing facilities. And so when you roll it all forward, one of the main reasons that we were sought out by the owners of Headrush Technologies, this climbing business we just invested in, is because we are known to be very knowledgeable and deep about the things that drive an active wellness business. And that from the management team's perspective, they saw us as someone who would be able to provide them the support in their growth strategies because of that experience, because of the knowledge of their business, and because we owned many similar businesses to theirs. So now with the 7th investment in the active wellness theme, we further have that reputation to be a leader, to be a source of where people want to bring people who have deals that they sourced or that we source to bring those to us. But importantly, we are also now able, through our portfolio operations group, to concentrate on initiatives that would benefit companies that have a similar type of dynamic within those active wellness businesses. And it could be what they do with sponsors or with some innovation around new products or looking at cross capabilities in terms of the either capabilities, distribution channels, putting the products sometimes, selling through one of those sister companies. So I think hopefully that was a it's a long answer to your question, but it is complicated in the sense that what we are doing is using this platform, as we call it, to create advantage for both our clients, our limited partners, but certainly for sure for the owners and management teams in these companies we invest in.
Yeah. I think that kind of summed up the what I was going to ask next, which was, around kind of what your general strategy and playbook in a typical buyout transaction. Obviously, I think the SBIC is going to be a little bit different in the fact that you are also going to have more structured solutions. So that's not going to be the same playbook as the normal buyout. But sometimes when I think of buyouts, like you were saying before, right? You think of the big funds that are making these big leverage transactions, little room for error to drive outsized returns, right? So think of like highly levered buyout transactions. Could you speak a little bit about TZP strategy when it comes to, the cost of credit in today's environment, how it affected your strategy with employing leverage on your deals, and how is it that your strategy is just different outside of the size? Obviously, the companies are much smaller than a larger buyout.
Yeah, well, we have always, as sort of understanding being operators and being always people looking for getting attractive returns that are, attractive also from less risk. The entire time we've been in business, we've always deployed less leverage in the buyouts than was available in the market. We have data that shows, depending on the year, we deployed 30 to 40% less leverage against what was available in the lower middle market, right? So, which itself is much less than the, larger cap market. But I think we just know that, as you say, and imply, smaller companies just don't have the same margin for error. And by definition, require almost always more investment, more build out of the team and infrastructure in order to continue their growth trajectory. So we always recognize that, and therefore we've always deployed lower leverage in our transactions. And so certainly on the margin, everyone's been affected by the increase in interest rates, but it's certainly not having the same impact in our portfolio that in the broader buyout marketplace. And we have companies that have no leverage or only a seller note sometimes, and then we'll have companies that may have 3 or 4 times leverage. But in those cases, we might have been able to borrow 4 or 6 times leverage because they were more mature, or a business like franchising, which has long-term recurring contracts. So I think we're always kind of below where the max is, and we're always conscious that there's going to be more investment and incompleteness in the companies that we're investing in the lower middle market. So I think that leads to a situation where increasing debt costs, less leverage being available, has not really had an impact on our ability to put capital to work, other than, I would say, more indirectly, that the overall market has slowed down and people, are been less likely to transact because of some of those external reasons. But in terms of what we own and the way our approach has always been, we don't have to change anything.
I guess if we wanted to have a true read on the U.S. economy, at least, right? To your prior remarks, I think it was 80% of businesses in the U.S. are less than 200 million in revenue, and those are the ones that you're invested in. So, how is it that portfolio companies what does the data say for your portfolio companies? Is the economy still growing at a good pace? Obviously, every company that I talk to on the lower middle market side here in South Florida or across the U.S., employment costs has been a drag, right? So margins, excluding any increase you could do in revenue, margins are tighter. But businesses seem to still be doing well, and they still seem to be growing. Is that what you're seeing within your portfolio?
Yeah, look, I think broadly speaking, yes, we own more than 30 companies, so you're always going to have, variances and there are different stages. But I would say that most of our companies experience some kind of the dislocation from COVID. Sometimes it was, better in the near term. Sometimes it was worse in the near term, followed by a recovery, or in the case of a lot of consumer businesses, kind of more of a destocking after a big stocking up on buying things. And so last year there was more muted growth in a lot of the businesses that face the consumer, although not all, just where some just again just grew more slowly. And we saw businesses that served companies, really have a strong year. And I would say broadly, our portfolio companies expect to continue to grow this year. Again, somewhat at different rates. I think, there's where the people have tightened up is on how long they plan out for. So I think, there's not like the same confidence level necessarily for the second half of this year, because of, a range of uncertainties around interest rates, inflation, elections. So I think it's more of a, there's a visibility in the next several quarters. And then, sort of, take it next step. And that's kind of a little bit of, I think, how sort of have to plan, and adjust, be ready to adjust. On the labor side, I think that we've had, and I think again, this is the benefit in the segment of the market we're in, not a dramatic impact on sort of availability of labor, or on the cost of labor. And so that's, I think, something that's probably more, concentrated in certain industries where there's been more greater inflation around wages, or certain geographies where there's a lot of regulatory sort of coming from states about minimum wage and so forth. So but there's no doubt about it, that everyone wants to pay you less for what you're selling them, and you have to just work constantly to know what your right benchmark KPIs are, and be very careful about adding headcount without knowing that you have, the growth that you're going to get out of that, and the return on the investment. So it's not easy. So that's why hopefully, if it was easy, everyone would be doing it.
Yeah. Well, Sam, obviously, I appreciate you taking the time and doing this podcast with me. I didn't know if you want to leave, the listeners that we have with any additional commentary or final thoughts before we kick it off.
No, I just think, again, I think the lower middle market, small businesses are an incredibly important part of the U.S. economy. I think the SBA program is a great program. It's been a good experience getting to know people in that ecosystem like yourself. And it's I would say a really refreshing sort of collegial group of people who just enjoy these type of companies. And so from our firm's perspective, we really appreciate, got a lot of help from different people, in the sort of ecosystem. And, we're hopeful that we can be, a good contributor to the goals of the program being achieved.
Yeah. Awesome. Well, so that concludes another insightful episode of Family Office Fundamentals. A big thank you to Sam for sharing his expertise in the world of private equity. If you have any questions or want to learn more about TZP, check out their website in the description of this podcast. Until next time, this is Zev Zaretsky signing off. And Sam, again, thank you so much for taking your time.
Thank you, Zev.
All right. See you, Sam. The information presented in this podcast is the opinion of Sierra Capital and does not reflect the view of any other person or entity. The information provided is believed to be from reliable sources, but no liability is accepted for any inaccuracies. This is for information purposes only and should not be construed as an investment recommendation.